Good afternoon, welcome to Stock Talk. I'm Jeremey McClean of the Hedgeye retail team. I'm here with Brian McGough, and why don't we get it going? Turn it right over to you, Brian.
Great, thanks. Hopefully no one heard what I just said, because I thought I was mic'd. All right, just a couple of big picture themes on retail here, and then we'll go into like speed dating with stocks. First, all joking aside, I'm absolutely tired of hearing about the retail is uninvestable call. It's the most consensus call I've ever seen in my 23-year career. Actually, it kind of, in some way, it does mimic the whole tech bubble, right? In like 99, 00, whenever the heck it was like, that was when Amazon's market cap passed Walmart and you couldn't buy anything in retail because everything was being e-commed. Now everything's being Amazon. So I'm gonna hit on a couple of themes here. One is how returns are eroding in retail, what we have to see in order to see that happen. And then I'm actually gonna hit on a bullish case that I think people don't really give a whole lot of credit for. And then lastly, why I think we've seen a sentiment peak. So first, there's a chart, I hope you see it up there on the board. First chart on the board. So you've got, this is back to 1900. This is your square footage in retail over time. It goes all the way back to the first Macy's store, I guess it was. Actually, that was what, 1858. So in that chart, you see the green area. That's your, that's like your stores on the street. It's like a corner drugstore. It's a Foot Locker store in like Midtown Manhattan. That's actually, it has been the largest part of retail square footage. It's now about half, which is fine. The dark blue area, the light blue area down below, that's like your regional malls. That's like your Short Hills Mall and your Galleria and things like that. Actually, we haven't added stores in the better part of about 10 or 15 years. The existing stores have actually grown. So like the Staten Island Mall has doubled in size. So that square footage is kind of petered out. The black area there, that's your problem. That's your strip malls. Those are under a lot of pressure. They were born about 25 years ago because it was an offset to the regional mall. Well, now we have another offset. It's called the internet. So that's like your Bed Bath & Beyonds, your Dick's Sporting Goods, although I think Dick's is a good long here, which I worry about. It's your off-price channel. It's Kohl's, it's Target. It's all that black area, and that's a big, big problem. So the big theme is that 12% of retail sales now is online. Well, guess what? Our kids won't shop online and they won't shop in brick and mortar. They're just going to shop and they're just going to get stuff. You need an appropriate balance of stores and e-com. I understand we won't get there for a while. That while might be 6 months, it might be 6 years, probably somewhere in between. But back to the chart there, if we have to actually give an implied square footage to every e-com sale. If you think about it, we have retail, we have square footage, we have sales per square foot. Well, we have sales that go online. We still have a brick and mortar there. But as we see e-com grow, there's an implied square footage. So if we assume that e-com goes from 12 to 33% over the course of 8 years, which we do, then you get to an incremental 13 billion square feet of space. So basically, you've had a bad economic model in retail with steady state square footage of 13 billion feet for 5 years. Now it's going to double. So that's the whole retail is uninvestable. Look, I do buy part of it. This slide here, it's going to show you the return profile for all of retail. And by return, I'm talking about its return on net operating assets. And you see we've been running, about 25, 26, percent, 27 maybe, it troughed out at 19. Well, guess what? Because of that economic model and how it's changing with square footage and e-com, our returns are probably going down to 6. Well, that stinks. And there's a couple of other factors too, accounting-wise, with operating leases. I won't bore you with it, but you're going to see a really, really bad trend here. And that's what I think everyone looks at that says, hey, we can't invest in this space. I think because of the sentiment and where it's bottoming, we're getting to a point where there are things you can really invest in. And these are your content owners. This is like your Nike. These are the guys who own the final mile. I would argue a Best Buy is there with Geek Squad. So there are a couple of really good names out there I'd point to. Here's the theme, which I think will be emerging. We'll have a black book out on this in a couple of weeks, which is the store becoming a DC and the DC becoming a store. So you have Amazon, who just acquired the Pratt & Whitney old headquarters up in, North Haven?
Yep.
It's probably going to be a 1 million square foot building, and it'll probably be a store, not a DC. It'll probably be a store. So you go in, it'll be a leased department store, it'll be really experiential, it'll drive traffic, there'll be co-tenants on the outside of it, and the REIT who's paying Amazon to occupy that space is going to jack all the co-tenants there on rent, and these will be your RHs of the world, your Arc'teryx, your Montclairs, your good brands that you can't find in an Amazon store. So the point there is you have like a DC, a big Amazon warehouse that's going to turn into a store with a lot of leased tenants and with robots who are going to do all the pick and pack, and there'll be an area in the middle where you probably fly drones. That's kind of sexy. It seems like, hey, it's way out there. Well, so is Amazon owning food retail space, and lo and behold, it now almost owns Whole Foods. So this is a really big theme. It impacts everyone, like everybody out there. Where you spend $1 out there at retail, it affects you. So lastly, I'll just hit on why I think we're getting to a bottom. One is a sentiment thing, and the other one's a real math thing. So the first is, I'll start with my mother. Why? Because she told me a couple of weeks ago, like a week and a half ago, hey, Brian, did you know that you've got Nike who's starting to sell product on Amazon? I was like, all right, Mom, A, I worked at Nike, B, it's my job to actually know that. When my mother gets to a point where she's kind of making the call, it's probably not the right call. The other point is, I don't know if everyone saw, a couple of days ago, there was an announcement that we now have a triple levered ETF that goes up on days where retail goes down. Great. Probably a sign of the top. I would say more of a fundamental sign is that you've got Amazon, just bought Whole Foods. Amazon's been comping in the US 25%. What if 2 quarters out you see Amazon growth in the US roll to only plus 19, right? Still huge, still amazing, but it slows at the same time it's integrating a huge acquisition. That is incredibly bearish. For overall retail, sort of, very bearish for online retail. You also have comps, you have e-com comps with almost every retailer except Ulta, except Ulta, at a really rolling hard. So if you have that trend, which I'm not making that Amazon roll call yet, but it's very, very possible. The other part of it I'll add on, like with Target and Kohl's and junk retail where, yeah, they put out earnings and they beat and no one cares and the stock still trades down. We've seen 2 quarters in a row where that's happened, especially with Target. Comped up 1 quarter, great, it's an anomaly. Comped up another quarter, it's still a garbage retailer. We're going to get to a point where if we see a certain number of quarters, a PM out there will say, wait a minute, maybe we actually need brick and mortar retail. I'm not saying that will happen now, but the over-under on us seeing that again in 3Q when for overall retail, we've got the easiest year-over-year compares in July and August. I don't know, so let's step back again. If you have Amazon who rolls, they're doing a big deal, retail sales accelerate, junk retail actually comps, good luck being short retail. So over a shorter duration, I don't know, I'd really keep that in mind. So I could hit on a bunch of stocks, I will. Chances are we'll get questions on them, so why don't we just break there?
All right, when we get rapid fire questions started. Feel ready?
No, of course.
Number 1, who's the worst management team in your space?
Well, my space, our space is all of retail.
Yeah.
So out of 300 companies, Hanes brand.
Hanes?
Yeah, and it's not, no, let's stay with the short answers.
Short answer.
Hanes, Kohl's.
What's the most important macro driver to your process?
The most important macro driver to my process is identifying management teams who have a macro process. As I've said with HBI, I actually think that company truly believes it's extremely poor plan. It can see 1 derivative out, it can't see 2, 3, and 4. There's the problem. They actually believe their own, you know what.
Gotcha. How long does it take you to develop a new best idea?
6 months.
Is Under Armour still a short?
Yes.
Who has the most aggressive marketing strategy in your space?
In all of retail?
Yeah.
Nike does, and they have the balance sheet for it.
What's the best looking subsector in retail right now?
Home furnishings. Although Ethan Allen and the tile store, whatever it
Tile
is,
shop,
just
yeah.
blew up, but yeah, home furnishings.
What's your favorite brand personally?
That's irrelevant.
What's your favorite short idea right now?
Hanes brands. I think it's going to 0.
What's your favorite long idea?
Nike.
And will our NOAA ever get above 30% in the next decade?
It might, yes, I think it will. You want to know why?
Why?
Because as we see square footage in the DCs that are levered by the stores, we see stores that are levered by the DCs, and you get that mix. You see the initial drop down. You have margins now that were at 12, now they're at 6. Maybe they go to 3. You can actually make a real case, not sure when, in a decade certainly, I think certainly, that we go back to historical peak and we break a new peak. Yeah. Unless 180 years of history is wrong.
There'll be big winners in the future, right?
Right.
All right, a few other questions here in the queue. One, do you have a view on Ulta?
I don't have a strong view on Ulta. I have the same view as everyone else on Ulta, which is, hey, the stock's doubled and I missed it. And it's the waiting for a pullback. Great, you wait for a pullback and then, the thesis changes. And it's like, well, waiting for $20 pullback, waiting for another $20 pullback. So I just missed it.
Gotcha.
So far.
Here's an interesting question. Who was I'll change the word, person at Kate who stabbed shareholders in the back, just keeping track so I know where he or she lands next time?
Yeah. Look, it was the board. It just bad board and management who didn't own stock. Coach is a great long here because it stole Kate Spade. Got it for $18.50. It would have been accretive if Coach got it at $29. But because the CEO, okay, so who is it? It's Craig Levitt and Deborah Lloyd. And they were on the Kate board. They're not incentivized with stock. They're incentivized with a $25 million check if it's acquired and they lose their jobs. That's how they get paid. If it's an $80 deal or an $8 deal, it doesn't matter. They don't care. And there you go. Great lesson there, actually, as far as deal speculation on a go-forward basis and motives.
Check the incentives.
Yep.
Thoughts on Tiffany? Your macro team is long rich people. Is this not a good way? Is this or not a good way to play that theme? So
our macro team's been right. They called it out. We were short it and backed off. Stock's up $20 since. Now it's at what, $92, and I love this short. And the main reason being is that it has a brand problem. Its business has been rolling ever so slightly. I would rather see a business like Abercrombie where it just tanks. Down 10%, great. It's a wake-up call. You have a brand problem, you have a management problem, you have some kind of problem. In the case of Tiffany, it's been so slow and steady, they don't realize, they being management, does not know or realize that it has a major problem. It's at peak margins. You've got activists who are talking about a cost-cutting store. It does not make any sense, and I have no idea who would buy it here. I won't say XYZ can't be bought. Anything could be bought. I'd be shocked if this were bought. Gotcha. Here's an interesting question, kind of segueing from that. Is Europe slowing? Does that make you worried about some of the international brands? You can talk about the macro call. Absolutely. Yeah, I do. You want to know which ones or not? Well, I'll tell you, the one you just talked about, Tiffany, you said like to short here. We may be long rich people in the US, but Tiffany has a big business in Europe and Asia. Mm-hmm. We're short China and short. China's, Darius's note earlier, right? Slowing China back half. That's a problem. Ralph Lauren, good luck with that. Big value trap in Ralph Lauren. Don't buy. Just do not buy Ralph Lauren. It's more likely to earn $250 than it is earn $475. A couple Nike athletic questions here. So with the Winter Olympics coming up, how do you see this impacting retail? Is there a bump for Nike? That's irrelevant. It's not like the summer, right? No, it's like no one goes out and buys a pair of Air Jordans because of the luge. it just isn't how it works. All right, last one here. Can Under Armour become Nike? Of course it can. Of course, will it? No. All right, know what? So Kevin Plank is a winner. I was about to say something I probably shouldn't say. His style is questionable, but he is a winner. The question in my mind is, what will he do to reinvest in that business to fix the organizational structure, which is still a legacy from when their whole business was the tight-fitting shirts that make you look more muscular than I am. Will he fix that? Yeah, it's going to take about $500 million. Will he do it? Yeah, he probably will, and he'll have to tap capital markets and either sell stock or do a deal at $10, $12 instead of 20. The stock should be a $10 stock or a $35 stock. It shouldn't be 20. Gotcha. And the over/under is lower. Over/under is under.
Got it. Thank you, Brian. We'll wrap it up there.
Thanks,
Thank you all for tuning in, and we'll see you next time on Stock Talk.
Stock Talk.